Could everyone please come in and take a seat? Good morning. I'd like to welcome everyone to Atlanta. Can't hear us? Is that better? I'd like to welcome everyone to Atlanta and Lisa's 28th Annual Life Settlement Conference. My name is Brian Nicholson. I'm Lisa's Executive Director. It's wonderful to see so many familiar faces this morning, Lisa members and other industry participants together in person at our flagship event for the first time since Nashville in 2019. I'd be remiss if I didn't begin by extending our best wishes to everyone that has been impacted by Hurricane Ian, and our thoughts are with the people of Florida and the Carolinas as they're affected by this disaster in the difficult time. Please also join me in extending thanks to all in the audience who joined us last evening at the Painted Pin for a welcome reception and evening of entertainment hosted by Coventry. I would like to thank Alan and Reed and the entire Coventry team for your hospitality. I'd like to review a few housekeeping items before we get going today. Please have your cell phones silenced through the course of today's event. If you need to take a call, please do so outside the main conference room. Bathrooms are located outside the grand ballroom and to the left. And please see a member of Lisa's staff team to address any questions that may arise through the course of today's event. And finally, in the event of an emergency that requires exit from the building, the nearest exit is located directly outside. The Wi-Fi information for today's event is shown here. Please join the network events at grand_Hyatt and use the password GRAND2022. Lisa's events would not be possible without the generous support of our membership, and I'd like to thank our 2022 strategic partners, Air Asset Management, the Bank of Utah, and Coventry. In addition, I'd like to thank Abacus Life, today's College Football Hall of Fame networking reception sponsor, and Lock Lord for their transportation or sponsorship of transportation to that event, Montage Financial Group, our closing session sponsor, Wilmington Trust, our name and badge lanyard sponsor, and ISC Services and Q Capital Strategies for their sponsorship of the recording of today's proceedings. Please join me in thanking these organizations for their support. I'd also like to thank Lisa board members John Welcom, Sherry Duarte, Stephen Shapiro, Chris Conway, and John Dallas for their engagement over the last few months as members of our annual conference planning task force. Please join me in thanking these individuals for their important contributions to today's event. In addition, I would also like to thank and acknowledge the contributions of Rich O'Neill, Malika Walton, and Uloma Agbana, members of the Lisa staff team, for their hard work preparing for today's event. This team looks forward to seeing you again at Lisa's Institutional Investor Conference, which will be held Monday, May 1st in New York City in 2023. Please save this date and stay tuned for updates regarding agenda planning, sponsorship opportunity, and additional event-related details. Our industry stands on the precipice of a new era of market growth. Through Lisa's coordinated efforts to address carrier encroachment, as well as the work being driven by and through our standing committees, our membership is engaged on several important initiatives to drive this growth. These initiatives include the aggregation of industry data, member ethics and market conduct, work to increase transaction efficiency, and coordinated industry messaging. Each of these initiatives accrue value to Lisa's members and serve as tools to grow our industry. I would like to extend my thanks to each of the members engaged inside these efforts. Our organization is stronger for them. If you're interested in learning more about any of this, please don't hesitate to contact a member of Lisa's staff. As many of you know, in December of 2020, Lisa's board of directors created an industry leadership award to acknowledge an individual market participant that has made significant contributions to support and development of Lisa and growing the life settlement marketplace. Mr. Alan H. Berger, the executive chairman of Coventry, was the unanimous first recipient of this award, which was presented virtually at our 2021 investor conference. I would like to invite Alan to the stage to finally receive his award in person. Alan, thank you and congratulations. Thank you, sir. Alan, in addition to your receipt of the inaugural instance of this award, I would also like to announce that Lisa's board of directors has unanimously agreed to rename this award the Alan H. Berger Leadership Award moving forward. I could not think of a more appropriate way to acknowledge your efforts to grow our industry. For this year's award, we are fortunate to be visiting Atlanta, which happens to be the home of two prominent life settlement industry leaders. Both Brian Casey and Brian Freeman have made significant contributions to the growth of our industry and our organization. Brian Casey, a partner at the law firm Locklord LLP and co-chair of the Insurance Regulatory and Transactional Practice Group there, is a current Lisa board member and former secretary-treasurer of the organization. Brian's counsel has been an asset to both Lisa and the life settlement industry generally for over a decade. Brian Freeman, the founder, president, and managing member of Habersham Funding, is a life settlement industry pioneer and former four-term Lisa president. Brian's role in advocating on behalf of the industry before organizations like NCOIL and NAIC was vital to the industry's growth. Mr. Casey and Mr. Freeman, please join me on stage as we honor each of you for your significant contributions to the life settlement marketplace by awarding you each the 2022 Alan H. Berger Leadership Award. And now, to speak more about Lisa's efforts to serve its members and grow the life settlement industry, I would like to introduce Lisa's Vice Chair, Sherry Duarte, who will be introducing our first keynote speaker.
Good morning. Congratulations, Alan and Brian. It is my privilege and honor to be introducing the next keynote speaker, John Welcom. John Welcom is the outgoing chair and one of the most experienced executives in the life settlement industry, working exclusively in the life settlement secondary market since 1993. John founded Welcom Funds in 2000, nationally licensed life settlement broker providing professional representation to life insurance consumers and their advisors. The firm has since established itself as one of the most active, respected life settlement companies in our industry. Welcom Funds ensures a fair market value is secured for all policy owners negotiating with top buyers in the secondary market who compete in auction process to purchase policies. Since 2000, the firm has helped thousands of consumers uncover the living benefits of life insurance. He's also been actively involved in spearheading the data collection that we successfully introduced and launched last year. Please help me welcome John Welcom.
Welcome, everyone. It's great to finally be back. 3 years since Nashville. A lot of things have changed. Hopefully, we've taken that corner and the industry is going to move in a much positive direction. I think we've got some good things for you today, and I'm here to show you a few interesting things that should improve the market if we get everyone working together and help promote and educate consumers and advisors. Just click this. A quick look back. You know, there's a lot of talk has been about the market declined a little bit in 2021. There were really obvious reasons for that. COVID shutdowns, face-to-face meetings were halted. Advisors couldn't meet with their clients. We didn't have meetings for 2 years. COVID also gave seniors a very good reason to keep their life insurance coverage because it was, specifically their target that was mostly affected by COVID. Many states also issued moratoriums on lapses. Distribution networks also canceled meetings, so the market participants couldn't educate and engage advisors to look at their book of business and make recommendations of life settlements. And the virtual conferences were the alternative, and those weren't very engaging. Rarely they had success. People were not engaged discussing settlements. You couldn't meet with people and speak with them. So finally, as we turn out of this, the meetings are back. Lisa's back. Right there. Advisors are meeting with clients again. COVID is less of a concern. Financial and industry conferences are running full steam. I know we have 4 or 5 set up in the next 6 months. I'm sure everyone else does also. And distribution networks are initiating life settlement RFIs again to introduce life settlements to their platform so that they can participate in offering this service to their clients. But how do we increase policy supply? Consumer awareness and advisor education. We need the data to prove to them that life settlements are a better alternative. Advisors are engaged in other products. They're much more important. They have other things to do. Life settlements really aren't even on their list. If they are, it's the 6th, 7th, 8th offering that they have. They come up once in a while, so it's not something that's on their mind at all times. But we have to promote the size of this potential market. The Lisa data collection uncovered our numbers for last year, and this is how they compare to the 2020 lapse statistics. 3,000 transactions versus 9 million lapses. $4 billion in face value versus $642 billion in lapses and surrenders. Consumers received $750 million from the life settlement option, 7.8 times higher than what was offered from the life insurance carrier as a cash surrender value. That resulted in $660 million more in clients' pockets. That's a pretty big number. So how do we keep going? TV commercials are obviously working. Phone calls are ringing. Those phone calls are creating advisors, new advisors getting into the market. They're calling, I'm sure they're calling everyone in the industry, so we're all benefiting from that. Internet marketing is obviously an important factor in that process because people always research things that they see on TV. So we have to make sure we have the materials and we understand what's happening when they're calling. We have to be prepared to screen those calls, speak to them, educate them. So that is definitely something that everyone has to understand how to do and, really qualify a case when someone is on the phone. Advisor education is a little bit more direct because you must network with them. The Lisa Market Data Project has given members the information needed to highlight the life settlement option to its advisors. For the first time in over a decade, we have an opportunity to promote real market data to distribution networks to show them that the benefits are clearly much more financially beneficial to a client than a lapse or surrender. Highlighting the data versus the annual lapse rates is probably the simplest way to do so because there's no argument. There's a lot of policies lapsing every year, and our industry is just a fraction of those numbers. Our industry should obviously be significantly higher, and advisors play a significant role in making that happen. A little disclaimer for the data. This data was sourced by the ACLI fact book, and I went back, 22 years, and it's pretty significant when you give it a look. It's a lot of data. How do you read it? You can total it. Totals are pretty interesting. Since 2000, from 2010 to 2009, 120 million policies have lapsed. Face value is $7.295 trillion. 2010 to 2019, 87 million policies lapsed, totaling $6.66 trillion. And since 2000, that's 216 million policies have lapsed, totaling $14.59 trillion. And that is significantly larger than the actual current size of the life insurance industry. So they're rolling over their existing policies probably every 15 years or so. But that's not the whole story. Oops. When you visualize the data and you graph it, you get a little bit different of a story. This is a graph of the face value of policies lapsed and surrendered for individual policies. As you can see, there's some spikes in there and there's lows, and you try to figure out which year the spike happened and why it happened. And when you look in a little bit of detail, it's pretty obvious. In 2020, we had the stock market, the bubble burst. So there was a spike immediately in 2000, as soon as the bubble burst. People who had money now were worried, and the first thing that went was the life insurance policy. It decreased a little bit the next year, but in 2022 was the true stock market collapse in October, which started the recession. So it's pretty clear that when recession started, if it starts, we have to start paying attention to lapses and surrenders. It occurred again in 2008, a pretty drastic jump in lapses. And then since 2008, we've been on the greatest economic run in US history. The only thing that gave it a little bump with lapses was carrier COI increases. So as you can see, the last few years have had a little bit of ups and downs due to carrier increases. So it seems to be right now that we're at the bottom of the lapse rates, and we are entering what some people think are a recession. The stock market's crashing. real estate market's declining. So right about now is when we need to be considering really targeting financial advisors and letting them know this information, because people could be lapsing their policies right now. So there's clear evidence that economic downturns trigger a major increase in lapses and surrenders. Our current economic times indicate that an increase in lapses and surrenders are likely to occur in 2022 and 2023. So, what is the future? LISA members now have a concise market data from the LISA membership data drive to demonstrate that life settlements are a better option than lapsing or surrendering a policy. And we need to start promoting that, whether it's on TV, the internet, phone calls, email blasts. We all need to use this data because you can't argue with facts. For many years, we've had advisors that just say, I don't get involved with life settlements. They just don't want to do it. But when you put it in perspective that people are lapsing their life insurance policies, we need to explain that getting $0 just isn't a good option when you have an alternative to receive $300,000 from a life settlement. So it's really a no-brainer, and we need to start marketing that. So let's put our efforts to work and grow the marketplace, work together for market standardization, and continue to grow the market together. Thank you.
I'd like to welcome Scott Hawkins. He's a managing director and head of insurance research at Conning. Conning produces strategic research for C-level insurance executives. He's been the author of Conning's Life Settlement Annual Report since 2007. Before that, he spent 16 years with Scandia Insurance Group, providing research services as well in the United States and Sweden. So, Scott, welcome. We look forward to hearing your 30-plus years of experience in our industry.
Well, my beard doesn't add to it.
And very wise. Thank you.
I'm not sure about the wisdom, but certainly the age.
If you need to move forward, use the green button.
Yeah, thanks. Well, welcome everyone. Good morning. I brought water up because I'm a little bit hoarse from the airline travel and the air conditioning in here. This is the fourth conference I've been to since May. All of them been really well attended. And I've noticed a couple of things now that we're back in person. First, every conference is now using an app to track everything. No more like handouts, no more big takeaway bags. And second, everybody is like really, really happy to be back together after 2 years of being apart or only existing in a virtual world. I want to thank Brian and Lisa for the opportunity to come here today and speak with you about what we're seeing, the trends that are driving the growth of the life settlement industry. And I know that many of you read the annual report that we produce. And I'll let you know that we're right now in the editing and production phase for this year's report. It should be out within the next week or so. So what you're getting here today is sort of a sneak peek at what's going to be in that report. And I'll be talking about some of the things that we're using that in our forecast in terms of drivers to help set that report going forward. In addition, I also want to give you an overview of how the companies whose policies you've bought have performed financially since through the end of 2021, and what that might lead for future cost of insurance increases or challenges for those companies or not. So for those of you that may not be aware of what Conning actually does, or you only think that the only thing we do is produce this annual report, I want to take a moment or two to sort of tell you who we are and what Conning's main business is. We are a global asset manager. We have about $190 billion of assets under management, about 111 of that here in the U.S. Our client base are life insurance companies and property casualty companies, and they've been our main clients for over 110 years. We began providing core fixed income asset management, and it's still our bread and butter business. However, as our clients have wanted to expand into different asset classes, we have followed suit. What you see here is that approximately 38% of our clients' AUM is with life and annuity companies, and about 26% is with property casualty companies. So life insurance and property casualty insurance asset management is our core business. So why did we write the life settlement report and do other types of research? Well, one of the things that we differentiate ourselves in the market compared to our competitors such as BlackRock and JP Morgan and others is that we're the only one that has a dedicated research team that looks at issues that are affecting the insurance industry, and we've been doing that for over 50 years. And this slide gives you a sense of some of the people that make up the team that I head up. And I've also been, as was said, writing this report for 16 years. Now, we produce about 100 publications a year. We cover all the statutory lines of insurance. In addition, we look at key issues driving the industry forward, and we do that both on doing our own research as well as a consulting basis. Now, we began writing about life settlements because our insurance clients, particularly the life insurance clients, back in 2004, 2005, wanted to know what was going on as this new industry was emerging called life settlements. So we wrote our initial reports that way. Over time, though, if you've been following our reports, our focus and who we're sort of viewing this industry from has changed to really take an investor's perspective. Now, why is that? Well, because we get contacted on a regular basis by potential investors looking to put money to work in this asset space. And in fact, it's one of the things that we use to sort of gauge broader interest in this space. You can imagine it dried up after 2009, only to reemerge in about 2014 and 15. So we get asked on a lot of times by potential investors what's going on and why. So we've adjusted our report accordingly. So as many of you know, we produce a 10-year forecast for the growth of this industry. So we're looking at through 2031. And we really look at 4 areas when we do this. There's the gross market potential, the net market potential, the annual volume, and then the tertiary market. And just to recap, the gross market potential is the total face amount of policies in force that meet investor criteria, that meet the criteria that you're using when you recommend buying a policy. Broad demographic trends and the criteria that you change and adjust over time affect that forecast. The net market forecast recognizes that not everybody that has a policy would consider settling it. So that really is based upon what is consumer awareness about life settlements as an option and an opportunity. What is distributor awareness? Those are factors that drive that. It was good to hear John talk about really driving that forward going in the future. The annual volume, that's the amount of policies that are settled in the secondary market each year. The tertiary market, that's the result of the amount of policies that are settled but are still available for trading. Now, the annual volumes are driven a lot by consumer trends, and I'll be touching base on those in a bit. So this year, what are we looking for in terms of main drivers? Well, broadly speaking, we always look at 3 categories in developing our 10-year forecast, and you see some of the specific drivers we're looking at this year. Overall, we think that through 2031, these drivers are favorable for continued growth of the life settlement market in terms of annual volumes and gross market potential. I'm going to focus today on economic and consumer trends because they really do play the biggest role in our forecast. The overall regulatory environment appears steady, and we anticipate that there will be continued life expectancy revisions over time, but we think investors today, and in our discussions with them, sort of expect that. So they're adjusting their sort of approach to the life expectancy risk differently than there was perhaps in 2005, 2006. So we think even though that will occur, there will be less shock going forward. So I want to take a dive into some of these. I'm going to begin with interest rates. The 2022 Q3 Philly Fed is that the 10-year Treasury will go from 1.44% in the end of 2021 to 3.56% in 2025. Now, the increase in interest rates holds the potential to improve insurer portfolio yields, life insurer in particular. Now, one of the things we do as part of our broader life insurance industry review and analysis is to forecast and estimate what those potential trends of portfolio returns for life insurers will be over the next 3 years. And in this slide, you see the impact of the prolonged low interest rate environment and its impact on those portfolio yields. The columns you're looking at show the actual portfolio yield that life insurers have been earning on their general account assets. The two lines represent what we've been doing since 2010 to try and forecast where those portfolio yields might be heading. And every year until this year, those lines decreased over our forecast period. This is the first year they've increased. They've done that because of the rising interest rate environments. So why are interest rates and portfolio yields important to forecast life settlements? Well, life settlement investors have shown a very strong preference in buying universal life policies, UL policies. Why? Because as you know, you can optimize the premiums with those to boost your returns. Now, those portfolio yields you saw on the previous slide support the amount of interest that an insurer can credit to its UL portfolios. Higher crediting rates are positive for premium optimization and increasing investment returns, which in turn attracts more capital to this market, which is a positive for the growth of life settlements because new investors will come to the space. The slide you're looking at here shows the actual UL crediting rates as reported by LIMRA for 2004 through 2021 second quarter. The columns are the range of crediting rates on average UL policies between the 25th and 75th percentile. That little dark spot, dark line, is the median. And as you can see, it's been fairly downward since 2004. Again, matching with the decrease in portfolio rates for the insurers. But we think we may already be seeing an improvement. In the second quarter of this year, the median crediting rate was 3.5%, which is higher than the 2020 rate of just 3%. But as you can also see, there's an awful long way to go before insurers are crediting back to what they were in, say, the mid-teens of this decade and the decade before. The other reason to understand where portfolio yields are heading is that many of you will remember a few years ago when the cost of insurance increases happened across the board. And insurers were doing that. And they gave a couple of reasons why that was. Investment spread pressure caused by their lower portfolio yields was one of those. So for our forecast, understanding the pressures life insurers are under in terms of their investment portfolios provides us with some insight into the risk of future COI increases, which could dampen investor interest in the asset class. Now, rising portfolio yields as a result reduce that risk, which is a positive for continued attraction of capital to this market. So taken together, we think interest rates and crediting rates will continue to rise, which will be a positive for growth of this industry. Another area we look at for the development of the future growth of this asset class is by looking at what's going on in the broader capital markets. And we do that as part of our overall industry research for a host of other asset classes. In the case of life settlements, we look at the demand for alternative assets and where that might be heading. Now, Pension and Investments and Willis Towers Watson has tracked the asset allocation of the 500 largest asset managers year by year. And this slide shows the percentage of those and the change of growth for these since 2016. As you'll see, alternative assets, of which life settlements is one, has had the highest compound growth rate, 14%. And this is not surprising given that low interest rate environment we've been in. Investors of all sizes and types have been looking for higher yields. Now, interest rates are improving, so what does that mean going forward? Well, if you look at what's being forecast by groups who follow the development of the alternative asset market, they're still projecting strong continued growth and inflows into alternative assets through the rest of this decade. That's being driven by a widening of the types of investors who are moving into alternative assets, as well as an increased awareness of the opportunity of investing in alternative assets. These assets, compared to others, are where you can really find some additional yield, and that's still attractive for investors. You know, there's a lot of discussion about the impact of recession coming in. You know, is it going to happen? How long? How deep is it going to be? And this year, it's something we're actually factoring into our forecast to try and understand that. Now, we're not making predictions of how long or how deep that recession will be. But as we've been thinking through it, we do see some short-term and longer-term impacts on the growth of life settlements. And those impacts are related to consumer spending and saving habits. Here you see two things. The columns are the disposable personal income for the average U.S. consumer. The red line is the personal savings rate. And this is since 2017. You'll notice the spike in the savings rate during COVID. Why was there the spike? Because people that were still working were receiving wages, sometimes supplemented by government benefits, but because of the lockdown, you had nothing to spend the money on. Savings spiked up as a result. Once the economy opened back up, however, savings dropped down to where it was, which is a relatively low rate for the American consumer pre-COVID. So while Americans are continuing to save less, reverting to their old habits, they're also reverting to their old habits of running up the credit card. Give you an idea, the use of credit, consumer credit, has exploded. Americans' total credit card balance at the end of the second quarter of this year was $887 billion, and that's from the Federal Reserve Bank of New York. That was a $50 billion increase from the end of the first quarter of this year. So if a recession happens, some cash-strapped consumers may turn to life settlements as a source for funds so that there may be a short-term increase in the supply of consumers coming to this asset class looking for a solution to their financial shortfalls. Longer term, however, even if the recession doesn't materialize or is just very short and very shallow, this combination of low saving rates and high consumer debt levels keeps that door open for economically strapped consumers to find other ways to raise income. So therefore, life settlements remains an opportunity that they may consider going forward. Now, the low savings rate and high debt issue and a potential recession is further heightened by the impact that equity market volatility has on retirement savings. As we all know, 401ks are the main vehicle that most Americans use to accumulate retirement assets. Now, the Investment Company Institute reported in their 2022 fact book that 401k participants in their 60s had about 40% of their 401k assets in equities. 401k participants in their 20s had about 20 to 25% of their assets in equities. Older age individuals are still heavily weighted towards equities. And you see that given this equity market volatility, this slide, which is not surprising. So the decrease in 401k assets went from 7.7 trillion at the beginning of this year to 6.5 trillion at the end of 2022. Equity market volatility will continue to play an impact on that, and these decreases in retirement savings is a big concern for a lot of retirees and near retirees. How are they going to be able to afford that, especially if they're strapped for cash because they've borrowed money and need to pay that back? Again, we think this is a factor from consumer demand that will lead to more life settlements going forward. Pardon me for a second. As I said, a little bit hoarse from the travel. In addition to recession, the other big economic story this year, of course, is inflation. And it's the response to inflation by central banks that's really driving interest rates up. And you see here the CPI from 1960 through early September of this year. And you can clearly see the spike from this year. And for those of us who are old enough to remember the 80s, you know, that was a period of very high and prolonged high inflation. The question is, how high is inflation going to go and how long will it remain? And more importantly, for today's discussion, what does that mean for life settlements? Well, to the extent that inflation is just relatively short and low or mild compared to what you see in the 1980s, that will help moderately increase interest rates, which is going to be a positive, as I've discussed earlier, for portfolio rates and crediting rates. But for consumers, retirees on fixed incomes and those with variable debt of various types, credit cards, mortgages, higher inflation is going to add pressure on their financial situation, which will likely contribute to further policies coming into the market. So consumer demand, we think, will increase. But will their awareness? Well, one reason we think a growing number of consumers will consider life settlements is seen here. It is the development of the direct-to-consumer life settlement market accompanied by commercial advertising and social media advertising. Now, our forecast is that there will be continued development of direct-to-consumer life settlements over the next decade, along with that mass advertising. And our thinking is if we revisit this slide in 10 years, there's going to be a lot more company logos on this. We think direct-to-consumer is an emerging trend for this industry. So as a result, we've now added the impact of a growing direct-to-consumer settlement business to our forecast because of that potential to really widen the set of policyholders that are coming into this space. Remember, our net market potential is based upon consumer and distributor awareness of the life settlement option, as John was referring to in his opening remarks. Driving that up increases the ability to generate more life settlements. Our underlying assumption, therefore, is that growing consumer awareness will happen, net market potential will go up. Now, we also think, though, that this growing consumer awareness and the emergence of a robust direct-to-consumer market is going to lead to more policies coming in, but they may be lower face value policies. So the industry is going to have to become effective at dealing with these mass consumer policies coming in and making a profit from them. So how do we factor that into our forecast for those of you who have been looking at it in the last year or so? We come up with our base forecast. And because we're uncertain about how and when this direct-to-consumer market will start to really take off, we provide you with 3 scenarios. What happens if it increases the annual volumes by 1%, 3%, and 5%? Now that gives you a range of ideas of how direct-to-consumer marketing and an option to settle policies may actually affect the growth of this business as it goes forward. Another factor we're looking at to determine the forecast for the tertiary market is excess mortality. One mortality trend since COVID has emerged that may have gone unnoticed is the drastic increase in the external causes of deaths, homicides, suicides, accidental deaths. And we see that in these 2 charts. On the left, you see the number of U.S. quarterly deaths by cause, and the line was the average mortality for 2018 through 2019. On the right, that's just the external deaths for those causes. So starting in 2020, the second quarter of that year, the external causes of death, especially motor vehicle accidents and opioid overdoses, jumped up, and they've remained elevated since then. The life insurance industry, and we had our client conference a couple of weeks ago, and all of our life insurance clients were talking about the chart on the right. They are very concerned about the impact excess mortality overall is going to have on their profitability of their books of business. Why is that? Because, and oftentimes for the older age individual that's had their policy for 10, 15, 20, 30 years, those individuals' reserves for that policy have been built up. Number 2, the life insurers expected that an older age individual is eventually going to file a death claim. So they've priced that into their modeling. What they haven't priced in and what's catching them off guard is this excess mortality that's not caused by COVID, because that's occurring among younger age individuals who may have bought a policy 5, 6, 7 years ago. Those reserves have not built up. The insurer is on the hook for more of the death claim that's being paid out. And it's an issue they're trying to work through and figure out how long this extended period of mortality is going to last. Now, if you just look at COVID, and it does become an endemic in a new flu, that still has an impact because that affects the older age individuals. And if they're talking about 100,000 excess COVID-related deaths a year, insurers have not priced that in. They understood flu, that was sort of built in. But excess COVID-related deaths, excess external deaths has not been priced into their pricing model. So what may happen to that? Cost of insurance. Remember, one of the factors that they used to try and raise a few years ago was excess mortality experiences. They're having that right now. Another COVID-related thing that is going to affect our forecast and this industry, we think, is the so-called long COVID. Now, it's recognized as a disease. Long COVID is really a whole group of symptoms. You see those on the left, and they'll range anywhere from a month to well over a year. The figure on the right gives you some of the ideas of how prevalent long COVID is. Approximately a quarter of COVID sufferers will go on to develop some form of long COVID. But for those with long COVID, there's a real economic impact. This summer, Brookings Institute estimated that right now there's 3 to 4 million Americans suffering from long COVID. And they're suffering a loss of $170 billion to $230 billion in wages. That's an economic hit to a lot of consumers. Some of those long haulers may turn to life settlements to help relieve some of that financial pressure. But what you have to realize that those long haulers are oftentimes younger-aged individuals in their 30s, 40s, 50s. Now, while this industry has a history of underwriting younger-age individuals, that was during the HIV pandemic in the 90s when you were really pushing viaticals. So as demand from long haulers for a possible life settlement solution to their financial needs emerges, and we think it will, we also think that you're going to be continuing to be cautious about underwriting those, because those individuals will have, or should have anyway, a higher longevity risk than somebody that's in their 70s, 80s, or 90s. The final two consumer-related factors that we think drive forward the life settlement forecast revolve around life insurance policies. Now, John talked a lot about the lapses and surrenders, and I'll dive into those at a more specific level a little bit later on. But they are key because ultimately it's the amount of policies that you have in force that is your supply that you're going to be investing in. And people have not been buying life insurance. What you're looking at here is the number of new life insurance policies, both term and whole life, that have been issued every year since 2000. We know that life insurance applications spiked in 2020, and that led to this spike at the very end on the right in 2021. Now that, and we wrote last year, was a positive if it was maintained, because that would increase the supply of policies for you down the road to invest in. If you factor out, though, lapses, surrenders, and death benefits, life insurers overall have been seeing a decrease in the number of policies in force. Those policies in force do have higher face values because policies are cheaper to buy now. A person that was spending $100 to get $5,000 of insurance can now buy $25,000 worth of insurance. People are buying larger face value policies, so that's why you'll see the face value of policies going up, the face amount going up, but the supply of policies continues to decrease. What we're not certain about now is how many of those spikes are going to remain in force, especially if we have a recession, especially if consumers face financial crises. Will we see shock lapses in 2022, 2023, surrenders coming along, and could some of those have been turned into life settlements, giving the people more money for their policies than what they might have earned if they bought a policy, say, 3, 4, 5 years ago? Important question to think about. And again, John alluded to some of that in his presentation. The other issue to take a look at, because overwhelmingly you buy cash value policies, whole life and UL, you do buy some term, is the supply of cash value policies. And what you're looking at here is the decrease of cash value ownership since the early 1990s. It's decreased. People tend to buy term now, not so much cash value. Now, why is that? When we look at this overall, each of these decreases has been associated with an increase in the estate tax exemption. People used to buy a lot of term, whole life policies in order to cover estate taxes. They don't have to do that. There's fewer of those that are affected by that. So as a result, ownership has dropped. But for our forecast, what we've noticed, if you looked at starting about 2010 through this, and this, by the way, is from the Survey of Consumer Finances, comes out every 3 years, so that's why it ends in 2019. The ownership seems to have stabilized. So for right now, we figure in our forecast that it's going to stay around this level. We're not anticipating a big drop in cash value ownership. And unless the state taxes suddenly ramp back up, we don't anticipate a very large increase in the amount of cash value policies. One quick question.
Are there fewer agents selling life insurance?
No. If you looked at the number of, the question was, are there fewer life insurance agents actually selling it? If you look at the number of agents that's reported by the Bureau of Labor Statistics, and it's one of the ones we do follow, you'll see that yes, there was, whenever there's an economic downturn, there's a drop in the number of agents, but there is also an increase. I think the bigger issue, and this addresses the issue that John mentioned, was that there's a very high turnover in agents. It's a business where somebody will come in thinking, I can be an insurance agent, and they find out it's a really tough game. It's tough to last in it. So you have to be constantly educating a new crop of agents or advisors about the availability of life settlements. I just want to finish up and then I'll take questions at the end, but please hold your thoughts. I just want to now touch briefly on the performance of the companies whose policies you've bought or advised people to buy. How are they doing post-COVID, and how are they comparing against the rest of the industry? And one of the areas I want to look at in here is, of course, financial strength and what may drive future cost of insurance increases. I'm going to begin sort of taking a high level for the industry. I'm going to look at death benefits and net operating gains since 2019 at a product level. On the left, you see the actual incurred death claims by the term UL, VUL, whole life, and others. Not surprisingly, every single product saw an increase in death benefits being paid in 2020 and 2021 relative to the pre-COVID years. On the right-hand side, though, it's been more interesting. You see UL losses, these are statutory losses, have increased. There was losses in 2019. If you look at term, it went from being a positive to a negative, but whole life and VUL has remained positive, albeit at lower levels than they were at pre-COVID. Taking a little bit closer look at overall death benefits, you're looking here at the quarterly death benefits and the year-over-year change. You know, historically, there was a pattern, and you can see it here with some of the flu issues, where in the first quarter and fourth quarter and first quarter, you'd usually see a small spike in death claims because of flu, which would settle down in the second and third quarters. COVID upended all of that because of the waves of the virus that went through, and really that and the excess mortality has now created a new environment where there's elevated claims across the year. What do we think is going to happen here, and what does it mean for you? Well, again, mortality claims go up, insurers are under pressure. They have used that in the past to justify cost of insurance claims. Will they do so again? It's something that you should be aware of and follow closely. The thing, though, to take a look at, and this addresses the issue of excess mortality on younger groups versus COVID-related claims on older groups. If those COVID or COI rate increases come through on younger blocks of policies, that may reflect the fact that they're seeing an increase in claims for those younger aged individuals. But if they're seeing it on the older age policies sold 10, 15, 20 years ago, that may reflect the pressure they're receiving from COVID. So it could help you understand why a COI increase may be happening and how you may want to respond to that. So turning from the industry, I want to let you know that we have been following 42 specific insurance companies since 2017. We went back then and identified a group of these companies that in your 10Ks and in some of your funding material seem to have been the targets of companies whose policies you've purchased. And we've been following their performance, sort of a control group over time. Now, I want to start off with looking at the financial strength of these companies, because ultimately it's their financial strength that guarantees the payment of those claims at some point in the future. Now, rating agencies, of course, AM Best, S&P, provide ratings. But the one we look at and pay attention to is their RBC levels, that's risk-based capital levels, because that's what the NAIC uses to judge whether or not an insurance commissioner has to step in and take over an insurance company. A level of 200% or below is a warning signal to the insurance commissioner that they may want to take a look at that company. Below 100%, they can step in and take over a company. And you're looking at the end of 2021, RBC levels for all of these 42 companies. Now, on average, the group of companies you and your clients have invested in ended the year with a 452% RBC level. The remaining life insurance industry had a 435% RBC level. So the group of companies you've invested in are financially stronger than the industry average, which is not surprising. You tend to go for highly rated companies to begin with, and it pays off here. It's just more evidence of being selective in who you're investing in. I discussed portfolio rates earlier, and I want to touch base on those in terms of the 42 companies compared to the relative industry. They've seen a lower decrease in their portfolio rates. They've only had a 35 basis point decrease in their portfolio rates over this time period compared to 43 basis points. That said, though, as a whole, they've earned a lower return on their portfolios. Over this period, those 42 companies had a 4.16% average portfolio return compared to 4.2% for the remaining industry. But those 42 companies include Equitable and MetLife, which were outliers. If you remove those, the average for those 40 companies jumps up to 4.22%, very close to the industry average. When we look at mortality, we see that the 42 companies that you've invested in have reported a higher mortality rate. This is the mortality rate's fixed amount of death claims over face amount in force. They have averaged about 35 basis points over this period of time in death claims compared to 28 basis points for the remaining industry. And I'm sure you're all aware that one of the big knocks that the insurance industry applies to life settlements is it's going to drive up their mortality claims. So the question becomes, is life settlements related to this? Can this case be made? And we've written about this, and I've spoken about it in the past. It's really, really difficult to make that case. And why is that? Because of reinsurance. The use of reinsurance reduces the financial impact from the primary carrier, which is what we're looking at, in terms of their mortality cost. It lowers their mortality rate if they have a higher cession rate. It does mean a lower mortality rate because they have laid off more of the risk. Now, if an insurer decides it wants to retain that risk because it will be more profitable to do so, those claims come through and they're going to have a higher mortality risk. So what you're looking at here is the cession rates for the 42 companies versus the remaining industry. Over time, the 42 companies have averaged a 13% cession rate. The remaining industry is 31% average. The remaining industry simply lays off more risk to the large reinsurers and retains less of it. So as a result, they have a different mortality rate. It's difficult to make a connection that life settlements is causing that. When we look at lapses, we see that the 42 companies here have a lower lapse rate for the life settlements than the remaining industry. For this period, they had a lapse rate that was 3.5%, lower than 5.7% for the rest of the industry. However, once again, we can't find in the data a clear link between life settlements and lower lapse rates. Part of that is because there's so many lapsed policies. Surrender rates, a little bit different story in terms of surrenders. They are pretty much in line with one another. 42 companies, they've averaged about 70 basis points of face amount lost to surrenders, pretty much the same for the rest of the industry. And again, it's very difficult to find a connection between life settlements and surrender rates. So let's look finally at profitability. This chart in the columns shows the actual statutory net operating result for the 42 companies. The lines show the operating margin versus the remaining life industry. Not surprising, we see net operating results in terms of dollars decreased in 2020 when COVID hit, and they continue to decrease. How long will they continue to decrease? Will this year be a year when they return? We don't know yet. We'll know probably in the next 2 or 3 months as reports start to come in. That said, though, when you look at the average operating margins, these 42 companies have been more profitable than the remaining industry. They've actually had a positive operating margin of about 0.8% over this period, compared to a negative operating margin of about negative 1.6% for the remaining industry. So overall, they have a history of being more profitable than the remaining industry. So in closing, as I look back over what we're seeing happening with the industry, where we think it's going, I want to leave you with 4 points. First, economic conditions we think remain favorable for the continued growth of life settlements in all the areas over the next 10 years, and our report will reflect that. Second, we think COVID and consumer demands will continue to increase because of COVID, because of financial pressures, and life settlements will be an option that many will look at if they're aware of it and if their advisors are aware of it. Finally, as you build out, and we think you will over time, build out more direct-to-consumer marketing and solutions, that's going to lead you to really rethink the business model for life settlements. How do you become more effective and more efficient at driving those mass policies through a new channel or through new distribution areas? And as a result, if you could do that, the market for life settlements will increase in terms of the number of policies and the number of consumers that are finding financial relief in this space. And with that, I thank you, and I know there's a couple of questions, and we do have time left. So, Alan, with an award, you get to go first.
Well, thank you. Could you comment on the movement of private equity firms into insurance company ownership and what that portends for the future?
So, funny enough, I just spoke on that very topic at the ACLI last week. It is, with life settlements, the area I've been following since 2013 for conning. Private equity and asset managers are moving into the insurance space, acquiring platforms. They are focused on annuities, and they're doing that because of the fact that they can capture more assets. For them, it's all about asset management. An insurance platform represents a source of permanent capital. Those long-tail liabilities, be it annuity or life insurance, stays on that asset manager's books for a long time. They can adjust their investment strategies for a 10, 15, 20-year investment horizon instead of a 5 or 7-year investment horizon that their typical clients have. So they can adjust the strategies differently, generate more assets, generate more fees from those. It is a trend that is altering the insurance industry, especially if you're publicly held. Even if you're not, you're going to be approached, and we've had conversations, your board or the management team will be approached by these companies and saying it's something you should consider. On the plus side, it's enabling insurers to totally restructure their balance sheets, rethink their entire business models. Do they want to remain in this particular line of business? Or will somebody come along that will take that off from my balance sheet and allow me to pursue an area where I do see higher growth? It is a major issue. It's reshaping the industry, and it is now attracting a lot of regulatory interest, both at the state level and the federal level. So it's an issue that's not going away. What does it mean for life settlements? We think that these companies will start looking at life insurers in particular. Again, they've been focused on annuities. Don't be surprised if they start really looking at life insurance liabilities to reinsure those onto their platforms. And if they do, the policies you own may suddenly no longer be backed by company A, but reinsured to one of these new companies who will likely have reinsured that policy off, retroceded it to a Bermuda-based insurer. So, big issue. I could talk to you for a lot about it, and I'd be happy to later. But I know there were some other questions.
What are you tracking? How much or how many policies are written through fintech, through TV commercials, people buying term online, not going through advisors? Because you did comment on the number of policies written through advisors or through data reported through, I don't know, employment you said, I think, or something like that.
Yep.
But how much is written through just online purchasing?
Right now, not a lot. The majority of insurance is still sold over a kitchen table, right? It's not changed. It's probably not going to change. People will go online and they will research look at policies, and then they want to sit down with the human to make the decision, because unless it's a simple term policy, there's a lot of factors to think about. That said, though, it's a growing area of interest for life insurers. There's at least 4 direct-to-consumer life insurers that have been formed in the last 2 years. The reason they're doing that is they're looking at the success of Progressive and Geico. They can squeeze that down. They're automating it, but these are newly formed companies, and we'll see how successful they are. But the basic business is still sold by an advisor. That's why it's important to educate advisors so that they know about life settlements as one tool in their overall portfolio. It also helps them out, by the way, when they're trying to sell a cash value policy over a term life. It's one more thing that they can talk to a potential client about as, down the road, you could use this to pay for college, you could use it for retirement, and if nothing else, you could always settle it on. There was one question, I believe.
We've got one from John.
Okay.
Hi, over here.
Back here first, sorry.
Oh, I'm sorry. You can go, Robin.
Yeah, I just wanted to make a comment about there might be the same number of insurance agents, but insurance agents are now encouraged to do investments and assets under management, and they hate selling insurance. So even though you might target them and say these are insurance agents, they're really not focusing their practices on the sale of insurance. They're much more trying to gather assets under management. So I think that's one of the reasons why there's less policies being sold.
That's a very valid point. The distribution channels themselves, because of regulation, are shifting from a focus on transaction commissions to more on asset management, so the advisor earns the fees. Life settlement has a role to play there, because if they can sell that asset, which is currently illiquid, and receive money, that could add to their asset class. But back.
Hi, John Mendelson with the Asher Group. We're a broker.
Yeah.
Any recommendations you would have from a scalability factor for our industry? You look at lots of others that would help us scale better based on the data you see.
So I will put it this way, and I'll give you this as an example. The life industry has been investing like crazy to try and scale up its direct-to-consumer, more digital platforms, just from a service aspect as well as a sales aspect. And I want you to think about this. This may give you some idea of how big that is. For every $1 increase in liabilities that they have on their books, they're spending $3 on technology. That's also reshaping the type of person they're hiring, because that requires highly skilled, very expensive computer and mathematics-based people to do that, and less as a result of the traditional back office person. So if you go down this path of really driving forward, in addition to rethinking your business model, you will be spending more on technology relative to the amount of business you're bringing in. And that is, if you think of that as an investment, then you need to think about, okay, when do I start getting my return on that? And not just on the hard dollars you're spending on technology and software, but the soft dollars you'll need to change to the people that are working with your company. And with that, I've got about 1 second left, but I'd be happy to take questions if there are others. Yeah. The omni-channel platform is the golden thing they're working towards. Part of the issue becomes, though, it gets back to the advisor. They have to disintermediate that advisor who really wants to keep control of the client. So the more they can do that, the better.
A few years ago, actually a couple of decades ago, I believe, the life insurance industry changed dramatically in the UK and in Germany, or in Europe, so I understand. And it appears to me that the United States is headed in that same direction, where agents, to take off on what Robin said, are no longer selling as much life insurance. Do you know anything about that and the parallels that might be drawn there?
Yes. So the one I would point to immediately is in the UK. I think it was a decade ago. Their FCA, the Financial Control Authority at the time, comes through and talks about the compensation that an advisor or an agent could get. And they said you really couldn't charge commissions, made it very difficult to charge that. And we see some of the states doing that here. that made a huge shift in the advisors in the UK towards a pure asset-based model. Think the classic financial advisor RIA model versus an insurance agent. It hollowed out that mid-level advisor that talked to the doctor, the professional, who's looking to buy, a 100,000, 200,000 pound policy. They disappeared, and people now have to deal with an insurance company directly. Those that stayed in the business focused on that upper net worth, high net worth individual because they're managing assets anyway. States are trying to put similar pressures on advisors here through greater regulatory environment, making them more having to follow a fiduciary rule rather than a suitability rule, which is an interesting thing because if you think from a fiduciary rule, you have to do what's in the best interest of your client rather than, if you're a captive agent or representing an insurance company, what's in the best interest of it, which you could do under a suitability. From a fiduciary perspective, oftentimes a life settlement should be something that you should at least discuss with your clients. So on the one hand, push towards fiduciary is, again, a distribution factor that may lead to more discussions with clients about the possibility and the appeal of doing a life settlement. But it gets back to the issue of that advisor first has to be aware of it. It also makes it harder, by the way, for the insurers to say, well, if you do life settlements, we're going to put pressure on you to no longer carry our products. And so with that, I know I'm over my time, but it's great. I will be here. I do have a flight this afternoon, so I'll be leaving right before lunch, but I'll be glad to answer any other questions. And if you have any other questions, I'm always available for email or phone calls. I'll gladly answer them and talk with you about any of these subjects or others. And thank you very much.
So I will just announce that at 11:15, we have Alan Berger speaking on carrier activity. So until then, for the next 30 minutes, we invite you to grab some refreshments. There's coffee, there's drinks, but it's also beautiful outside. So maybe get a little bit of fresh air, make a new connection, and we'll see you back at 11:15. Thank you.